Big thank you to the ETF Global team, Mike, Jim, the whole team have done a great job of standing up this conference, and it's really well attended. So excited to be here with all these fantastic panelists. I'm Victor Werney, head of North American Exchange Traded product listings at Cboe Global Markets. For those of you that don't know, Cboe operates 27 markets and exchanges across the globe and is the listing venue to over 800 ETFs in the United States and over 1,200 ETFs globally. I'll turn it over to each of the panelists here to give a brief background on themselves and their firms, and then we'll dive right into it.
Hello, everybody. My name is Burke Ashenden, Vice President at Innovator ETFs, overseeing our capital markets and institutional strategy. Innovator is an ETF issuer focused on defined outcome ETFs, have around 22 billion in assets under management and 140 ETFs focused on this space.
Hi, I'm Rishi Rajan with West Financial. Together with First Trust, we offer the suite of FT West, Target Outcome and Target Income ETFs, with the largest issuer of buffered and defined outcome products in the US. My background is from the world of derivatives and banking. So.
Matt Collins, head of ETFs for PGIM Investments. PGIM is the asset management arm, the $1 trillion asset management arm of Prudential Financial, the large insurance company.
I'm Scott Becker. I work for Calamos Investments, been there for about 20 years, working on the investment team. We're a newer entrant into the ETF market, but we started with our capital protected kind of floor downside protection. And it's really been an outshoot of what most people know Calamos Investments as, which is convertible securities, which again is quite similar, managing risk reward, upside participation with downside protection.
Hey everyone, Johan Gran, Allianz Investment Management, built and launched the Defined Outcome ETF business for the firm about 5 or 6 years ago now, and happy to be here and take some questions.
Awesome. So I know each of you will have a different take on this. In the most simplest terms, what is a defined, structured, target, buffered outcome ETF? I'll start with you, Burke.
Great. So Innovator pioneered the Defined Outcome ETF. So we launched the first ETF in 2018. A Defined Outcome ETF is really simple. It's taking the types of payoffs you've seen in the structured note world. So it can be a buffer. It could be a set level of income. And that defined level of protection or income is what differentiates a Defined Outcome ETF from a normal ETF. So you can pick your buffer level. You have 9, 15, 30% downside protection. And in exchange for that protection, you're going to have a cap on the upside. So again, the interesting thing is Defined Outcome ETFs have grown significantly, and we'll talk about this more today. It's more so the wrapper that has brought numerous benefits to the structure, but these types of payoffs have been around for decades in the structured note world, and we just shepherded that type of exposure over into the ETF wrapper.
Just to add to that, the way I like to describe to investors is we used to, like in this world, in this room, for example, as well, we're used to the index trackers where the goal of the investment manager is like returns off the index, or active, where, trust me, I've got a great strategy, or, me as a person. But what's missing in this picture is bringing like more reliability, more, expected returns at the end of a period. Like that's what was missing. So the defined and reducing uncertainty aspect of it, that's what target outcome products bring to the market. And the payoffs are just so many times. It's just growing as the market is getting more familiar.
So I think in our industry, I'll put it in client terms, the most overused and misunderstood phrases is cash on the sidelines. It means 1,000 different things. It's interjected in almost every financial conversation with our clients. The ultimate problem that defined outcomes or ETFs are trying to achieve is everyone knows they need equity-like returns to retire comfortably, right? To meet their goals, whatever that's saving for a house or retirement. But hardly anyone's willing to take that risk when they actually think about it. And the way we describe it is defined outcome ETFs are put in a window frame around your equity experience, whether it's the S&P 500 or the NASDAQ or a whole variety of options. The goal of that is to get people off the sidelines and get comfortable with equity exposure. And there might be a rocket ship taking off above your window, and there might be a bankruptcy going below the window. The window frame is what the client sort of wants to see from their equity experience. And these defined outcome ETFs sort of allow clients to ease into the equity market in a way that fits their portfolio.
Yeah, I think so far they've all been great explanations, and I would agree. I think really what a defined outcome ETF, what we've done with the zero floor, you can't lose minus expenses, right? You get your protection back. Is you're just trying to add some degree of certainty to a very uncertain thing. And again, so yeah, everyone wants to be in the equity market because that's how you make more money. But the downside is what prevents people from probably doing it at an appropriate level or being in at an appropriate time. So if you can kind of manage that risk reward to some degree to help your clients kind of understand, we're going to participate with the equity market's upside, but we're going to protect you on that downside. That's just another comfort level, another step to help clients say, all right, this makes sense to me. Thank you. You're helping me. You're not just giving me what the market does. You're helping me manage my portfolio.
Yeah, and I can take a little bit of a different twist, I guess, to it. I would say that it's for any investor that's not comfortable being 100% invested in equities. They all have to make a decision at that point. And typically it's, right before retirement or when you're in retirement, you say, well, I probably should scale back on my equity position. And the question then becomes, what do I do to execute on that? So the whole point is to decrease the risk, because at that point in time, the sequence of return is what might kill you. And we all know this. It's the primary. There are multiple reasons for why you want to move away from equities, but that is the primary goal, is to dampen the volatility or decrease the risk of a complete meltdown in the portfolio. You outlive your assets. It's a simple equation. But that's where you can start thinking about how a defined outcome ETF might be able to help solve for that. And I'm guessing we're going to talk more about that later, but that's conceptually how you can start thinking about it. If you haven't heard about defined outcome ETFs or thought about it in the past, I would just urge you to start thinking about it that way. What do I do with the investors that cannot afford to be spending or investing their entire portfolio in equities?
Thanks, Johan. So there's over 300 of these ETFs out there today with over 55 billion in assets under management as it stands. Who are the main users of these products today and why? And could someone easily replicate this on their own?
I can start down here. So from Innovator's side, I would say that typically it's financial advisors and RIAs is how we built our business at Innovator. That being said, we're seeing a lot of interest on the institutional side as well. That's a good question, Victor. Could you replicate this yourself? And it's something we look at a lot on the capital markets side. As we know in this panel, and it's the ETP forum, when you bring these types of exposures into the ETF wrapper, it unlocks numerous benefits. I mean, the obvious ones we all know are transparency, tax efficiency, but really what are the benefits of the ETF for a structured payoff? Well, if you try to construct this on your own, most institutions and most advisors I speak to do not want to touch an option. They don't want to manage options. They don't want to have to deal with expiries. They don't want to have to worry about trading the strikes, the collars. It's complicated. Now, if you could send that payoff off to someone else to manage, like an Innovator or a Milliman or anyone else on this stage, and you can package that in the ETF wrapper, a couple of really interesting things happen. All of these ETFs have what we call outcome periods. So the outcome period could be 3 months, it could be 1 year, it could be 2 years. If you want to achieve the defined outcome of the product, you have to hold it for the You have to hold it for the entirety of the defined outcome. So if you buy a defined outcome ETF that has a 1-year outcome period, you can sell it 6 months into that 12-month outcome period. But the benefit when you bring this into the ETF is if you tried to do this on your own, we've found that constructing this with options, you'll get an inferior cap, so you won't be able to get the same level of upside that you would get instead of using an issuer like Innovator or First Trust or one of these other firms. And then secondly, too, the tax advantages. So at the end of that outcome period, one of kind of the magic pieces of a defined outcome ETF is that it rolls within the structure. So at the end of that outcome period, we're going to move to a new basket of options, and that is not a taxable event for investors. That's critical because with a structured note, it expires, and that's immediately a taxable event for clients, and they have a decision to make. If they want to buy another structured note, they want to reallocate elsewhere. These ETFs can live in perpetuity, and that's why we're seeing them used in model portfolios as core holdings for pre-retirees, retirees, or conservative investors. So I don't think anyone on the stage will tell you that you should be 15 years old, you should buy a buffer ETF, and that should be your core exposure forever. But as we know, the pre-retiree and retiree crowd is gigantic. And the game changer on why these ETFs have grown so much is that there was never a solution that allowed people to define their outcome at the beginning of the investment instead of the end. So you have a built-in buffer, a cap, an income level at the onset of investment. So again, the benefits I would say are tax efficiency. Trying to construct it on your own, you would get a headache, and most people don't want to manage options.
Yeah, for us, I think we have a really big annuity business. We've raised about $30 billion over just the last couple of years on equity buffer annuities, and that particular vehicle, for all the obvious reasons, has a significant lockup period, has a significant redemption fee, and the ETF structure, I think, brings some democracy to that, right? It allows everyone to access a defined outcome, and if you survey all of the investment strategies we have across our firm, I think defined outcome is the most applicable investment strategy that we offer. It is a goal-based ETF, period, right? And I mentioned it earlier. If you have a goal to buy a house in 5 years, defined outcome makes a ton of sense. Should you put it in your 401k at age 25? Probably not. But for goal-based investors that need something at a certain time, these work for every type of investors, but you can access it much easier than you could your typical annuity.
To add to that, like the payoffs that we are seeing, they are not new, to be fair. I mean, they've been around, they've been used in structured notes, they've been used in the options market. You call them a put spread collar, right? But what differentiates is, like Burke was mentioning, is in the wealth channel, most advisors, most individuals cannot access options for many different reasons. It could be compliance, could be just the pain of doing it across like 100 different sub-accounts. So that single ticker solution and the understanding of controlling the outcome, that's the big revolution, I would say.
Yeah, I would agree. And I would think just from the point of ease of use, I think it would be just a huge pain if I was an advisor and every time a client came into my office and said, I want to do something, you have to kind of rework it, and I have to strike the flex options around what today's date is, what today's price is, where are interest rates at, where is volatility at. Are you getting the same experience as the client who came into my office a week ago? I would like that to be the case, but that might not be the case. So I think it's a huge nightmare if I'm in your shoes, and it's just so much easier to kind of outsource that to somebody, who's like ourselves. We've got an options team that's been doing this for 40 years with convertible arbitrage and option strategies. You can put all of your clients into that kind of structured, and Calamos, like others, we also have laddered, where it's not I'm buying it on this date for 1 year. I'm buying this wrapper, and I get the August 1 year, I get the September 1 year, I get the October, and it just keeps moving. So all of your clients can have that same experience. Therefore, you guys get to spend more time doing what you're better at than our options desk is, and that's talking to clients, trying to understand what are their needs, what are their outcomes, and what are their goals. And it's kind of just dividing up the work in a much better way, I think.
Awesome.
Yeah, I mean, final brief point on that. I mean, unless you want to run an options trading desk full time, then you shouldn't be doing it. And I think, Burke, you said it best. You can't do it if you run over-the-counter options. We all trade flex options, thanks to SIBO. And by doing that, we can do it at scale, and that's really what's going to give you the best possible outcome every time. And then the second option, I would say, no pun intended, that was stupid. But the tax piece too. Yeah, you can buy these ETFs and hold them indefinitely, and you decide when you want to cut loose and realize capital gains. So there are a few simple reasons for why you may not want to do it, but I honestly can't remember what the first question was.
No worries. Johan, we'll transition to the next question and start over with you on that side of the panel. I'm sure the audience is curious, with all the different variations of defined outcome ETFs out there today, what would be ideal for the current market that we're in today on the defined or buffered outcome side?
Yeah, so you can talk about the current market, and you can talk about using these vehicles tactically. And that is one of the beauties. For those of you that are familiar with structured notes, it's basically a structured note in all its simplicity, but it's liquid. So if you want to trade tactically based on a specific market environment, bullish or bearish, you can do that. But the vast majority of investors will trade these strategically and hold them as an anchor allocation in their portfolio, either to de-risk equities or to re-risk fixed income, or to clean up the alternative sleeve because it's a little messy or a little bit complicated, or it didn't deliver exactly what you were expecting. So in terms of the long-term implications, it's really more of a portfolio management, risk-reward type of trade-off conversation and implementation idea for the long term. But yes, in the current market environment, well, do you think you're going to go into more volatility, or do you think you're going to see the long end of the curve come up more, or do you think that we're going to see more inflation or less based on fiscal policy? I mean, your guess is as good as mine. But all that said, if you have a view and you want to trade bullish or bearish, this is a very easy way to do it. You can re-risk towards the equity risk premium by buying a buffer ETF instead of something like bonds. Or you can, if you have a more bearish view, you can buy buffered ETFs instead of having full exposure to the equity risk premium all in. So it's very flexible, very versatile type of products, and I think that's the convoluted answer I can provide, frankly.
Yeah, I think, you know, is there an ideal market? I don't know that that's the case. We only know the ideal market after the fact. I don't suppose this is not a bad market, right? The S&P's up, what, 27%? Most of it's on PE multiple, right? 7 in earnings, and most of it's in valuation. At the same time, the long bond's gone up 40 basis points. So how do you square those two things together? That doesn't make a whole lot of sense. On the other hand, you've got a handful of industry companies that are massive free cash flow advantage. They're bringing in money hand over fist. So I think it's almost like the risks are on both sides of that even. You're an idiot if you don't own these companies. You're also an idiot if you own all these companies and that's all you own at these prices. So how do I step into that? How do I manage that risk, and to borrow a phrase, kind of narrow that window of outcomes that I don't know where I want to be? So I think this is a great vehicle for that. But to me, it's not necessarily when's the right market. Again, we only know that after the fact. It's who is this right for? And I think it's that more risk-averse client, that client who's getting closer to the end of their kind of time horizon as far as the willingness to accept and take volatility. Right? A 25-year-old probably doesn't want the market to go down 20%, but really doesn't matter, especially if they're going to be adding money at some point, you know, in the near future. It's actually a good thing. But if you're a 60-year-old or a 70-year-old or an 80-year-old, boy, you really don't want that, right? You've made your money. You'd like to grow it better than inflation, but you certainly can't lose it. And so these defined outcomes really help you in that scenario with that type of a client.
So for options, there's no phrase that rings more true than no free lunch, right? You don't get a free lunch today unless you listen to us and the other panelists. But with options, what you protect is what you give up. And as an investor, you need to think very seriously about what is the optimal scenario for your portfolio and your clients. We went back with 100 years of data. We looked at annual returns on a monthly basis going back 100 years. When the market is negative, it's negative 11.8%, so 12%. We offer a 12 buffer exactly because of that. That buffer is really meant to be sort of your long-term optimal buffer level that gives you the best balance of protecting against the downside, but giving you a good amount of upside to achieve, you know, an 8% plus annualized equity return. So that's your sort of normal case. In today's environment, when you look at an S&P chart and you're like, this seems like a pretty awkward entry point. We have a 20 buffer, and I think, you know, across the panel it sort of ranges from 12 to 15 to 20. The 20 is meant for that off the cliff scenario to protect you against right down to the bear market. That's a more tactical solution that I think actually fits potentially today's more frothy valuations.
So I definitely agree that, you know, target outcome products today have become more than just buffer. They are all like evergreen products. They are meant to be investor portfolios over a longer horizon because of the role they play. But the point I wanted to just add, since, you know, like most of our speakers have added a lot of details, is the world of target outcome is actually growing now. There are more payoffs. There is more than just buffers now in the market, and whether it's, you know, uncapped participation in the market. So there are options available today, and like, you know, as we've seen, like investor views are just diverging right now, especially, you know, after the elections, and there is more in this suite.
Yeah, I would just close with, I think there's always a market for certainty, and I think a really good point someone made earlier is that it's about the audience, not necessarily about the market. And so these products are designed for pre-retirees. Pre-retirees and retirees. So that's the crowd that we're targeting with these types of ETFs. Now, you can look at the market and you can look at volatility, you can look at interest rates, and you can find products that you think might look more interesting. For instance, we launched 100% buffer ETFs this past year. A couple other firms on this stage have similar products. That's basically a principally protected note equivalent in the ETF wrapper. That was a really compelling product because at one point last year, you had a nearly 10% upside cap to the S&P 500 with full principal protection. People looked at that product and went, holy smokes, that's twice what I'm getting in treasuries right now, and it's tax advantaged because I'm going to pay long-term capital gains and not ordinary income. So we saw a lot of flows into that product and into that suite during that period of time. And I think that's probably worth noting is that, the caps will change. The protection on a buffer ETF is going to be consistent if you buy a 15, a 30, a 100% buffer, but those caps will fluctuate depending on the market. The cool thing about the products is that they're always going to be applicable. Like if we go back to COVID and when rates were at zero, we saw everybody move from their bond allocation. They squeezed all the juice out of their bonds because rates went to zero, and they said, I need more upside. What am I going to do with my bonds? So a lot of them moved into a defined outcome or a buffer ETF into that bond sleeve. And we found a lot of that to be sticky. Even today, we see not just the hedged equity and the conservative equity going into buffer ETFs, but an emerging trend is that we're seeing a lot of that bond portfolio go into buffers as well to get more upside.
So, Burka, that leads right into our next question perfectly. In a traditional asset allocation model, how do you view the allocation between bonds and defined outcome ETFs today?
Yeah, it's a mix. I'm sure we all have conversations with advisors and institutions up here, and we'll have varying views. The great thing is that, like I said before, these can fit into a model portfolio, so you can choose. You have flexibility as the advisor. You can choose your buffer level. You can choose your cap. You can choose your floor. You can choose your income level. You have options. We have model portfolios on our website that you can use if you want to talk to one of our wholesalers or one of our research specialists. We can help you because there are a lot of defined outcome ETFs at this point. So how do you pick? That's why it's important to work with an issuer that has an experienced team to help you with that asset allocation. But high level, I would just say, conservative, hedged equity, core equity for some of those pre-retirees and retirees, and now very much emerging as a portion of that bond sleeve as well.
Awesome. Does anyone else want to come in? Yeah.
Add to that, Burke mentioned about this, bond portfolio users who were given where rates were had switched over. That was an interesting use case we saw a lot about. But I would say the core use case we've seen is, you have, say, a 60-40, right? And many variations of that under models. And when you add in a defined outcome product, what it does is it reduces the average sort of volatility, as compared to just a standalone equity sleeve, what it does. And what you end up seeing a lot of, sort of model managers end up doing is they don't need as much in their bond portfolio as well, bond allocation as well. So it changes the mix of both the equity and the bond sleeve, and you suddenly free up room to do a lot more along when you add in a defined outcome product into your mix. So.
This is the most challenging thing that I think we deal with. I think you guys would agree. Where does it fit in a portfolio? Because it's essentially a reconstructed bond with the equity market driving your coupon. And what does that mean for the portfolio? And I think you do have to look at some traditional stats. There's Sharpe ratio and standard deviation, depending on the buffer level, but I'll give you general visibility. It's about half of the standard deviation of the equity market and a third of the return. And what we have found, I think you touched on this, is it allows FAs to get a 60-40 up to an 80-20, or a more conservative client out of bonds into an equity-like return without taking on full risk. So I do think it's an open question for the industry, but on the spectrum, it's cash, it's bonds, it's buffers, it's equities. And that's sort of how you should think about it, and the buffers really sort of fit in that middle piece of the portfolio. But I certainly haven't heard consistently where people are pulling their allocations from.
I'd agree. And with Calamos, again, we're kind of known for being the convertible bond managers. That's been a question given to us forever. Where does this go? And the answer is yes, right? Sure, just, we can do this for you. I can tell you, years ago, we did have institutions that would use convertible bonds as their bond allocation, and they would, I don't think this is being recorded for legal purposes, they would cheat their bond portfolio, right? They'd get a much better outcome out of their bond portfolio by using convertible bonds. They'd get that downside protection that they really wanted because they wanted some certainty as to what their AUM would be, or like downside protection, so to speak, but they would get a better return out of it. We had an institution come to us and say, we want to put a good slug into your ETF because we want to do it that way. So you can. I do think this tends to look and feel a little bit more like equity. Again, it's going to be less, or it's capped upside, but that downside protection is something you don't get in the equity market. So again, it's a trade-off that I think is worth it to a lot of people.
Yeah, you a lot of times also don't get that downside protection in a fixed income portfolio, just to be clear. But I think the simple math, if you're considering like how do I allocate this and how do I think about it, the very plain and simple math that I can oftentimes functions to lead into the more complicated conversation is if you're allocating 10% of a portfolio to a 20% buffer, you multiply the two and you have 2% of portfolio protection overall. And then you can just scale it from there. Am I happy with 2%? Do I want 4? Is it just 1? How am I thinking about this on the equity downside protection for my overall portfolio? So 10% allocation to a 20% buffer, 2% protection. Simple enough. If you want to go a layer more complicated, you start saying, well, what about correlation and diversification benefits? Because that's the way I'm usually thinking about this. What about my Sharpe ratio, et cetera, et cetera? Well, it immediately becomes more complicated to speak in the language that most of us are used to. And if you isolate and hone in on the ETF that you're looking at, so I'll give you an example of the 20% buffer. You have 20% of downside protection if the S&P 500 is down within that buffer, so less than 20%, over that 1 year outcome period, then it goes from $1 to $1, and you basically had zero correlation to the market, even if the market was down by 20%. Most people say that's a pretty good outcome, especially if you get equity exposure at the same time. And you flip that and you say, well, the market went up, and let's say that you had a cap of, let's make this up, 12% on the upside, or call it 10% on the upside. That's the max you can get. Well, you have very, very strong positive correlation to the equity market as it's going up, regardless of where it's ending in that underneath the cap. So very strong correlation on the upside, point to point, and zero effectively on the downside as long as it's within the buffer. Now, if the market rallies beyond the cap, you have very little correlation to that market because you stagnate at the cap. But you can see how the complexity carries into the portfolio in terms of how you think about what do I actually get. And this is when you start talking about how do I time this, how many of these things do I buy, and now you start talking about time diversification. So this is a very long-winded way of going down that rabbit hole of, is this a good diversifier for the portfolio? And you bet it is. But can you quantify this in a modern portfolio theory, Monte Carlo simulation that you run? No, you just can't. So it's a little bit of intuition, a little bit of gut feel, and a little bit of trust in the process. But those are the variables that you can hone in on.
Awesome. So for potential investors looking to get involved in these products, is there anything that they should be aware of? Is there a certain time of the month that may make sense more than others for them to jump into these products? Is there a way for them to dynamically see how much is left in the buffer on either side? I'll open it up to the panel if anyone wants to take that one on.
Yeah, I don't know that there's an ideal moment in time necessarily, but I know that Calamos has on our website, we show you where the cap is, how much are you until you realize the full potential of your upside, how much above your downside floor are you. I'm sure the others have the same thing. So it is quite easy to see and simple to understand. It might take a second or two. The one thing that I would say is when we first launched some of these, right, so we said, okay, well, you have absolute downside protection. You can't lose your money, but you get upside potential, and it's capped. The one question we would sometimes get is, well, who gets the money after the market goes up 8%? And are you guys keeping it? We're like, no, we're not, right? So that would be the one thing that I would say maybe the client doesn't understand is, are you taking the money after it goes? No, that's the trade-off. Everything is a trade-off. There is no free lunch. That would be the one thing. But there's no perfect day of the month, time of the, it's where do you want to be and how do you want to manage that risk reward?
Yeah, I would just follow up on that. So I think education is critical, and it's funny, we've done this panel for a couple of years now, and I guarantee most folks still don't know what a defined outcome ETF is. So education is going to be so important to the growth of this space. All of us have tools on our website. We have a potential outcome analyzer, a personal outcome analyzer. We've even had ways to PDF it so you can hand it to your client to see exactly what that outcome was. So we've worked, I think, collectively as like an issuer industry really hard on creating these tools to simplify the message so everybody can understand their outcome with these ETFs. To your point, you said, is there a specific time to buy it? We mentioned outcome periods before. So these ETFs have a 3-month, a 6-month, a 12-month, some have a 2-year outcome period. You can buy the ETF intra-period, just like a stock. It's going to have intra-period liquidity. The spreads are going to be extremely tight. You don't have to buy it on the first day or the last day, but I think it's worth noting that most of our clients typically get in on the first day of that outcome period within a couple of days before or after, and that's because they want that full advertised defined outcome. That being said, they don't have to. If they have a liquidity event, we talked about selling a house earlier, or they want to pay for school, you can exit that ETF intra-period, and you can still capture some of that upside gain and still deliver you some of that protection. So I would say, just pay attention to where those defined outcomes are, use the tools on the website. They're there for a reason.
For us, I think everyone on this stage, I think these are the providers that have the full offerings on this stage today. And we have so many products because you need fresh offerings. These are not really set it and forget it instruments. We offer the ladder ETFs for portfolio construction and set it, forget it, because it buys all 12 months equally. But if you're buying a defined outcome ETF, you have to stay on top of what's left, what's the new cap once it expires. It is for us, I think everyone on the stage would agree, a big business to offer these products effectively. You have to offer every month, you have to offer, at least on our side, and I think everyone here, every 15 minutes we're updating how much of the buffer is left on our website. The education material is, I think, one of the most stringent standards in our industry to educate people on these products. It's a big business, and everyone on this stage is really committed to it, but you have to stay on top of what's going on in these products.
Totally, I would mirror that education is the number one. A lot of resources on the websites from the issuers, a lot of usable, printable material that advisors can take. In addition, I would say is the sales coverage and the process at which these products are being sold, like with First Trust as an example, it differentiates quite a bit because these products require a lot more, consultation on how to use it, how to fit it in your portfolio. Everyone has a slightly different view on how they want to adjust the risk of their portfolio, how they want to construct it. So this is, use all the resources available to be surprised by what's there.
Awesome. In terms of distribution, kind of switching gears here, how are each of you distributing these ETFs today? Are they really being incorporated in model portfolios for the most part? How else are you getting the word out about these defined outcome ETFs?
Let's start with us. So we have a wholesaler team, and then within that team, we also have research specialists and portfolio specialists. So it's kind of tiered, right? Like we have people that are out there covering various territories, speaking with these advisors, and then we have a portfolio solutions team that when that advisor is ready to move to the next level and they understand how it works, we can show them how to implement. But again, I mean, it gets back to education. Where does it fit within the broader portfolio? I don't want to overcomplicate it. Like we're talking about, you have to look at it. Yeah, you have to look at it. You have to know where the cap and the buffer are. But this is not a product that when it's in your portfolio, you have to stare at it every single day. And I'll give you an example of a reason why. So a lot of these ETFs have annual outcome periods. We're seeing tremendous growth in the quarterly outcome periods. So those are ETFs resetting every 3 months. That ETF, with its more frequent reset, requires a little bit less attention because when money is coming in throughout the year, that advisor knows that that buffer is going to be resetting and that cap is going to be resetting more frequently. So we kind of put that in the single ticker solution side of things because that frequent reset means that the advisor doesn't necessarily have to ladder all the different annual outcome period ETFs anymore. They know that every single quarter there's going to be a fresh upside cap and a fresh downside buffer. So again, we simplify the message when we talk about them. We don't talk about put spreads and short calls and long calls. We talk about outcomes, and I think that's really critical. What is the outcome that your client is going to get? And that, I think, is what's going to lead to continued growth in this space.
Totally agree. Distribution is key, and in our partnership with First Trust, that's, been the key part, the unique distribution structure that First Trust has, the sort of presence across the country, across communities, and to be able to educate in detail working together with us at West. And that's how I would say the adoption across the industry is growing, is by making FAs who are just used to fixed income and equities aware how this adds value to a traditional portfolio. Just expand.
So, if you look at the asset growth, Victor, I think you said 50 billion plus in this industry. That figure, I believe, has doubled every year. And believe it or not, I would say the core users were using these in other structures, and they were somewhat sophisticated in these options. I don't think we're anywhere close to where this industry will be in 10 years. I think it has a fit for retail direct if you can market it correctly. I mean, we're very focused on REAs and independents now. I think platforms are next, but I think platforms have to figure out performance management back to their clients with these products. So the next phase, I think, are the larger platforms, and then beyond that, I think you have even broader sort of retail distribution, because again, as I mentioned earlier, these are applicable to almost every investor in the market.
Yeah, Burke took my answer, so I know I should have sat there. No, I mean, distribution is full on, boots on the ground, wholesalers that are at your disposal, a product solutions team that can help you look at your portfolio. If we implement these, how does it look? What's that going to mean for my risk reward, my Sharpe ratios, et cetera? And then I think it's doing things like this, getting out and talking to people, because, our clients, our end clients are watching CNBC, and they're out there just trying to scare the hell out of you out of two sides, right? Either you're going to lose everything, or you're not making enough money. How foolish are you, right? So it's this fear paradigm, and there is a solution, like we've all just said here. There's something in the middle, right? And most people are more willing to give up some upside if they could be more certain about the downside. I just don't want to lose all my money. I'm willing to not make quite as much money. That solution does exist, so it's just how do we get out there and let everybody know that this does exist and this can be placed in their portfolio?
Yeah, not to beat the dead horse here, but it really is about the education first. And we've had so many like aha moments, but it takes a little bit of time to get there. But once the people we work with, the advisors we work with, the model strategists that we work with, once they get into this, I mean, a lot of people will geek out on this and like they found the next generation of investing. So it's pretty cool once you see that happen. But knowing this, we've also built a dedicated wholesaling team within Allianz that focus only on buffered ETFs. That's all they do. That's all they talk about for that reason. And so they cover the ground across BDs and RIAs as well. And then if the easiest path to get into like the bigger conversations, if you manage your own money, if you manage your own portfolios, I've been doing that both on the institutional side and the retail side for 25 plus years in previous roles. So if you want to talk about that, I'm here all day. That's an easy one if you want to get that conversation going. And I will also say, like, we've talked a lot about caps and buffers. And a lot of times the early questions that we received was around, how do I get more than the cap? I mean, I don't want to be capped out. I want more than 12% or more than 15. Like, what do I do? So we got sick of listening to it. And as you know, there's no free lunch. So we said, well, we'll just flip that equation around. And we're just going to take the first 3 or 4% of performance of the S&P 500, and we'll give you the rest. And we'll put a 15% buffer underneath because that's going to cover you in about, I don't know, up to 90% of any market down year. So we just flipped the equation, and then people say, well, 3 or 4% that I'm not going to get, that sounds like a fee, we don't like that. And the same question, are you going to keep it? And it's like, not how it works, right? It's literally option structure and how we build it, and we try to do it efficiently. But the key point here is that if you have more than 5, 6 plus years to invest, if you invest in an uncapped version of a buffer, and you kiss goodbye to the first 3 or 4% of returns, you get all the rest. Those are the returns that actually matter much more than those returns that go underneath of the cap. But it's a mind bender for most investors to get their arms and head around this. but statistically you can run the math very easily and see what the outcome is. And it's a pretty interesting option for anyone who's looking into buffered ETFs.
Thanks, Johan. So it looks like we're just about rounding up on time here. So we'll do one last question. I'll ask each of you, kind of looking down the product pipeline, what are you most excited about in terms of Defined Outcome 2.0 or other options-based exchange traded products in the near future? I'll start off with you, Burke.
So when we think about the total addressable market for this space and how Innovator thinks about products, we always use structured notes in the structured product world as sort of our North Star to see what we're going to bring to market next. Anything we do is going to be advisor-driven, so we have lots of conversations with advisors to make sure there's client demand for that kind of structure. But you said $50 billion at the beginning of this, Victor, and I think sales and protection annuities sold, I think, around $260 billion last year. So not to say, we sit up here and we say, it's a full replacement for structured notes. And we have plenty of advisors that use Defined Outcome ETFs as a complement as well. There are reasons that people still use structured notes and annuities. But even if you can just get that first step and complement some of that exposure with a Defined Outcome ETF, we really think we're in the early stages here. I mean, 50 billion is where we're at. I think you could easily add a zero to the AUM of the space when you look at structured notes, annuities, in that space. And what do we think is next? 100% buffer ETFs was a new innovation this past year for our industry. We think there are so many different structured payoffs that once you bring them into the ETF wrapper, you unlock everything we talk about: the liquidity, the transparency, the tax efficiency. So I would not expect the deluge of products to slow down from this group. And that's because once you bring them into an ETF wrapper, it's simply a better mousetrap, and advisors and institutions prefer that structure.
Yep, totally. I'll add on to that saying our philosophy, like as a senior product development person myself, is not, just keep building mousetraps, right? And then expect let's go sell this. It's always been listen to the advisor and come up with a solution that meets their needs. And we definitely see that, the stellar growth of this segment has been, noticed, but it is because the need was there. There are a lot more payoffs today that exists in other wrappers. I mean, it could be structured notes, it could be in the annuity side, it could be, as a just direct option strategy that people are running themselves. And there are many that we're working on. I mean, I think the best I could talk about is, the previous panel also talked about exotic payoffs. There are some very, very popular ones in the structured note side that, you can fit into note side. But there is more coming because as advisors are getting more educated about these basic core payoffs, they are asking for, hey, what if, I want this without this? And so we are looking at, how broad is that question, and then providing solutions. There's a lot more.
So we see the data on our insurance side from the annuities, simple sells. People want the index that they're familiar with, and then they want to pick the buffer that works for their investment strategy. And as I mentioned, I would caution, the industry to be a little skeptical of the one-ticker solutions from providers that see all of the money going into options and options-based ETFs. You have to have a complete offering, which again, everyone on this stage does. You have to have fresh offerings for your clients, so when they're ready to invest or get liquidity out of their defined outcome, you have an ETF that has a fresh sort of cap and buffer. So you need a lot of ETFs, but that doesn't mean they're all complex. And I think from our simple is have a lot of offerings on the basics, on the indexes that and a buffer level that works for the long term. So it may look like 40, 60 products, but a lot of them are just sort of different months and variations on things investors know well.
Thank you, guys.
Wait, we have two more. Scott,
yeah, I'll try to make it quick. Yeah, I think as far as innovation goes, I think anything that is liquid that has options, you can do it. The more vol it has, the more exciting that is. The other side is maybe you do things that aren't necessarily defined, like with options. So we have a strategy where it's called CAN-Q. We try to create basically a convertible on the NASDAQ 100.
Cool.
Upside participation, downside protection, but it's not absolute defined.
I think there's plenty of product out there. I think you mentioned 300. So 100 of those came this year alone. So I think there's plenty of product development is always interesting. I think the risk is that there is some over-engineering potential. There is plenty of option to choose from today. So for me, the most exciting part is that academia is now starting to pick up on this. And you can see it, for example, if you sit down and study for the chartered ETF analyst designation or something like that, I think it's called, they actually have a whole chapter on buffered ETFs now, which I think is a sign of where this is going. So for me, the excitement is around adaptation more broadly, more so than additional products.
Awesome. We're good to go. Thanks so much, everyone.